Welcome back to Succession Stories. I am so excited for my guest today. He understands the tension between growth and freedom, between momentum and intentional design, where so many founder CEOs get stuck. He knows that space intimately. He's lived it. He's a former Inc. 500 CEO who scaled, led, and exited, and now helps founder CEOs do the same with intention. He's a certified scaling up and metronomics coach, a certified exit planning advisor, an Inc. magazine contributor, and host of the From Angel to Exit podcast. Bruce Eckfeldt, welcome to Succession Stories.
Hi, Laurie. It's a pleasure to be here. Thanks for having me.
Of course. This is going to be a good one. We speak so much of the same language. You've got amazing experience. We're going to talk about what it really takes to scale smart, build transferable value, and prepare for an exit that both serves your business and your life. But I want to start with you. I want to learn a little bit more about your founder journey. Yeah. You've been an Inc. 500 CEO. Looking back, what did you structure well for scale, and what do you wish you had built earlier to make your exit smoother?
Yeah. There's probably more on the last question than the prior. I think the thing to know about my kind of journey is I had no real ambitions or intentions to actually be a founder and CEO originally, right? Like I was an architect. I got involved in technology, late 90s, had a kind of very fun and really kind of unique, exceptional career on the digital kind of agency side. So I got recruited to New York to kind of work with the agency world in the late 90s. And that was when everything kind of got crazy in the .com. And I had flying around Europe working on these projects. And so I had this really kind of fun, exciting career that was a little coming out of left field. But it got me into technology, and then early 2000s, 2002 specifically. We started a project. I left the consulting group that I was with, and we started. I had a co-founder, a friend of mine, basically at the time, and we were building a product for another company. And that led to another product. That led to another product. We got another project with a different company, right? Like it just kind of snowballed in a positive way into a company. And it probably took a year or two for me to kind of realize that, this wasn't just a project, like we were actually building something. And, so it was interesting because I got very engaged and very, I was very into the whole idea of building a company, but more kind of from the architecture side. Like I got very, very interested in the complexities and how do we do this, and how do you actually scale a company? And so, I went through all the coaching or all the frameworks. I did scaling up and EOS and MAP and strategic coach, or I was like anything I could find to help me kind of figure out how to grow and scale the company I was involved in. But it wasn't like part of my identity or my ego to like be a founder and CEO. In fact, I probably had a lot of kind of imposter syndrome or a lot of just kind of challenges of actually stepping into that leadership role, which was good. It was a good experience for me, and it certainly taught me a lot. But I think that really kind of shaped my kind of scaling and exit journey in terms of not necessarily having a strong or this kind of integral attachment to that role. And I think the positive side is it allowed me to be a little bit more strategic, a little bit more thoughtful. Like I could kind of, look at it objectively a little bit more. I think that the flip side was I did sort of struggle with it at times in terms of, do I really want this role? Is this really something I want to do? So there was a lot of just kind of personal motivation that I think I grappled with as part of that journey. But it was, it was unique, and I'm really thankful and really appreciative of having the experience. My exit was, complicated in the sense that I had switched partners. I brought in another partner later in the business. And so we had equity involved, and we had to figure out how to disentangle the equity because we realized we didn't want to continue with the company. So, I think the takeaway that I found around that was I hadn't done a lot of the personal work to kind of figure out what I was going to do after that. I knew I wanted to exit, and I knew I wanted to have a transaction, but I didn't really know what I wanted to do next. And as much as I trusted myself to figure it out, there's a lot of things I wish I would have done differently in terms of building myself a platform prior to that transaction.
I love that you reflected in saying you were an accidental founder. That's a very interesting scenario where, some people are very specific about it. I want to be an entrepreneur. I want to found a company. And you had a project that eventually led to a company. That's really interesting because sometimes I ask on this show, is there an entrepreneurial gene? And if so, what does it mean to you? And I would guess, based on what you just said, maybe it was always in you. What do you think?
To some extent, and I think the through line for me about if I look at all parts of my career, and I've kind of changed roles or changed paths along my career several times, there is always this kind of underlying architect kind of thread there. Like I love kind of figuring out problems and designing solutions, and I talk about elegant solutions, right? Like having this kind of design thinking, like let's not just fix it, but fix it in a way that is unique or interesting or has some kind of aesthetic or some kind of cultural value. And so, the company for me was another kind of architectural endeavor. And then the work that I've done since then in terms of coaching and working with leadership teams and developing strategies is just another format for architectural thinking, right? Thinking about how do we figure out what the problem is, what does the solution need to achieve, how do we design it, what's the structure, what's the meeting, what's the process for building, right? Like there's all of that kind of architecture energy gets activated for me in there.
That makes a ton of sense. I love that. I love starting here in this space because I think a lot of founders think about scale and then exit as separate chapters. But
Yeah.
I'm willing to bet that you believe that they're really connected from day one. Let's talk about that. How do you talk
Yeah.
to owners about that dynamic?
Yeah. So, I mean, what I found is I started just helping CEOs, leadership teams with scaling strategy and operational plans, right? So I would come in, we'd figure out, okay, you're a couple million, you want to be a couple 100 million. How do we do this? This is how we do it from a market point of view in terms of, positioning, in terms of operational plan, in terms of leadership development, right? Like I kind of got very involved into the scaling side of things. And I've had several clients that have scaled successfully, and then they kind of get to this point of what do I do with this thing? And they've had some very nice exits, but what I realize is two things. One is they don't really have the sense of what they're going to do after. So the post transaction ends up being a little, at best, they have a whole bunch of resources and now they have time to kind of figure that out. Worst is they're trapped in situations that are actually not serving them well or preventing them from doing what they actually want to do. But I think, and then having worked with a lot of founders on thinking through that exit strategy while we're scaling, what I've realized is if I can get a founder to actually develop a post-exit plan that is motivating, that is compelling and interesting to them, they'll actually push the exit, right? They'll actually be like, now I actually really want to exit because I want to go do this thing that we've talked about, right? Now they're motivated and they put a time frame on it. And if we can figure that out, then we can figure out what kind of exit they need. Like not only timing, but what does the structure need to look like? What kind of resources does it need to apply? Does it need to supply not only financial, but reputation, network, all the things that all the other kind of value you can get out of that process. And then they actually want to grow faster, right? They actually want to implement the things we're doing. So, well, I think it's really important that exits have a post-exit vision or founders have a post-exit vision. What I find is it actually helps my coaching, helps my growth coaching, because now we're motivated. Like they want to get to that number. They want to actually have that transaction. And sometimes I was thinking about doing this in 5 years. Now I want to do it in 3, or I wanted to do it in 3. Can we do it in 1? Maybe we can actually get this thing to where you want to be, or based on what you really want to get out of this transaction, maybe we could actually do that in a year. Maybe we don't have to be a $100 million company. Maybe we can be a 30 million, right? And maybe that's a much more achievable goal in the time frame because that's really what they need to be able to go on to that next step.
How difficult is it to get owners to think about their role outside of the company? Is it largely around their identity? Is it around their value system? All the above?
Yeah, it's all the above. It honestly kind of depends on the founder and why they got into it, the nature of the business, how they're attached to the business. I certainly have worked with founders that are like, I just want to get rid of this thing, right? And they're like, but it's hard because they're often still very attached to it from an identity point of view. They're just frustrated with the business and the stress and the workload, and they've just put themselves in really just a bad day-to-day operational position. And I have other founders who are like, yeah, like this, they've set up a very nice system, right? They really don't have to be involved on a day-to-day basis. They've got a lot of freedom. They're doing the things that they love, but they're also kind of like, yeah, but ultimately, where do I go with this, right? Like I haven't really exited. Like I've I've removed all of the practical burden. Like it's easy for them, but it's still theirs. And whether that means they've got value tied up into it that's unrealized or at least not liquid, or it just preventing them from going off and doing something else, those are probably the harder ones because there's a lot of trappings and there's a lot of good things about their situation. And sometimes we kind of need to upset the apple cart to get them to actually want to make a change because they could do this for another 5 years without any issues.
Right. I want to talk about some of the hard truths with founder dependency. I see it in small companies that are in the lower middle market, let's just say 10 million and under in revenue. That's not a shocker. We might not have the resources to build an extensive bench. Companies that are larger, I'm willing to bet you though, they still have owner dependency issues. What have you seen in owners who are the constraint?
Well, I mean, the constraints typically come up. So the big one tends to be sales, right? Is when the founder is the rainmaker, right? And they've got the network, they've got the reputation, they can close the deals, right? And that one is hard. I would say from a psychological point of view, that selling is such a hit, right? Like it's such a dopamine win that getting founders kind of literally unhooked from that rush is tough, right? Because they love and typically they're doing it because they love the art of the deal, right? They're salespeople. They love the pursuit. They love the closing. They love the win. They love putting numbers on the board. I would say that's probably the hardest one I run into in terms of it's really risky for the business. It really hurts valuation. It really makes the company hard to sell from a transaction point of view. And it's really hard on the ego, right? Like getting, oftentimes founders that are kind of lead salespeople, like that is, like I said, it's just a huge dopamine hit for them.
Yeah.
Right. And so to get them off of that is tough. The other area that I run into a lot is where I work with a lot of kind of very technical, smart founders who are sometimes are in the best in the world in this area, in this domain, and that's why they've created this company. But all of the kind of intellectual horsepower of the company is tied up into the founder and is very dependent on them being able to kind of drive that intellectual leadership. So it's not so much that they're selling, but they're critical to the kind of uniqueness and value that is created by the company. And honestly, that one is hard because their kind of thinking is, well, I know more about this than anyone else. I should keep doing this. And the problem is they're usually right? They usually are the smart. I mean, sometimes these people are the smartest people in the world on this thing. And it's just hard to get them to appreciate that. I get that, you're right, but we can't scale a company based on this. And it's hard to sell a company based on this. We have to figure out how to make this institutional knowledge, not individual knowledge. And, in many respects, you're de-optimizing, you're creating a situation where it's not as smart as they are, but that's the only way we're going to scale it. And that is can be a very hard pill to swallow. And honestly, I've had situations where we kind of have to make a call, right? Sometimes they're like, yeah, no, I want to scale and I want to, transact. And so we'll figure out how to do it. And we bring in other leaders and we systematize the knowledge and get it back into the organization rather than to the founder's head. Sometimes he or she is just like, no, I want to be able to do it this way, right? And that's fine. But then we're either trying to create a bit of a cash cow, right? Like we just need to figure out how to create a lot of, free cash coming out of the business so that we can amass value that way. Or we've got to figure out some kind of strategic exit where, the buyer is going to be okay with that kind of situation. And there's some kind of, earn out process or some way in which they can extract value of the organization that's very dependent on a founder. And, those are complicated deals. The valuations are much more nuanced in terms of how we price those kind of transactions.
Yeah, makes sense. We talked a little bit about exit readiness, and I want to talk about that in the context of optionality. I think that there's a big misnomer. A lot of baby boomers have been stuck in, well, here I am, and this is where my business is what it is. I can't make any changes. I think the Gen Xers are looking at them going, yeah, I don't want to do that. I don't want to do it that way, right? And so do we have an owner mentality that we can impact our future and be in control of our future exit? What are you seeing with your relationships with business owners? Are they thinking about this in the sense of, oh, I'll just continue to kick the can, it'll happen someday? Or are they not going to operate this business forever? They're more realistic about it, and they want to do things differently than the baby boomers have done.
Yeah. Um, well, so some of it is a little bit of a selection bias, right? The people that end up coming to me and the deals and the situations that I kind of see tend to be founders who are not sort of looking at this as sort of retirement, right? Like if this isn't like, hey, I'm ready to stop working and I need to figure out what to do with this asset and I want to sell the company or figure out how to monetize it in some way. They tend to be founders who are like, hey, I've got 15 other ideas and this is a great company and I want to see it successful and I want to see it grow, but I have these other things I want to do too. And usually there's also a little bit of, I've been doing this for 5 years or 10 years and I'm kind of ready to do something else. Like there's a little bit of fatigue. So usually in those situations, I'm working with them on, it's both this push and the pull, like figuring out, okay, what is the push? Like, why do you want to sell this? Like, what is the negative aspect of this that you're trying to get rid of or put distance between you and the issue versus what is the pull? What is the thing that you want to do more of, or what do you want to do next? And how do we map those out? And then how do we figure out what the time frame and the needs need to be? So I would say I tend to end up working with more strategic founders, or at least founders that are willing to think more strategically about it. What I do find on the other side of it is, unfortunately, the couple of cases I've been in where people are in that position, there's usually some kind of externality that's forcing the situation, right? Whether it's a life change, divorce, or health issues, or they are like look, I'm done. Like I really do want to kind of move into more of a retirement mode. And if they haven't really planned for that in some way, and we haven't done, a non-trivial amount of work when we have kind of the space and time and energy to do it, doing it under the gun it is tough, right? There's only so much you can do. Once you get some kind of pressure involved, it's hard to make good decisions, or at least it's hard to make well thought out decisions, right? Like we'll make the decisions that we need to make based on the situation, but it's just there's less options and there's less ability to kind of create options when you're under time pressure, particularly when it's external factors that are driving.
Yeah, it could be like what would be factors, right? It could be market factors, competitive factors, but it could be health and well-being of the owners as well. Yeah, I totally agree with you. That's my experience as well, and I think it just it sort of underscores. Look, people always ask me, well, when's the right time to start planning? And you would probably agree, I would guess, that, look, the best time was yesterday.
Well, when you started a business, the second best time is today.
That's right. That's right. So if you want to preserve optionality, you really need to be proactive about it and have an intention for it. So I think that's a key message. I want to switch gears a little bit and talk about legacy. And, the name of this show is Succession Stories, so that shouldn't shock anybody. When a founder steps away, whether it's by choice or circumstance, what do you think separates businesses that thrive in the next chapter from those that stall?
Well, the things that I've seen, there's kind of two sides of it. I mean, one is kind of the business side of it, which is really like, do you have a clear strategy, right? Like, have you thought about your strategic positioning? Do you understand what's happening in the market? Do you really understand your core customer? Have you created a really well differentiated space that allows you to sort of charge a premium, rate or a premium price, or you're on the premium side of the market? That gives you leverage, right? That gives you the ability to then make moves, right? If you're stuck in a fairly commoditized position and you're fighting on price, you just don't have a lot of room to invest in things. You don't have a lot of insight in the market. You're basically just being driven by competitors' price, and you've got to either meet or beat that, and that's kind of a bloody situation to be in. So I would say the one thing I would look at is the strategic side. Have we really created a unique and valuable offering in the market? And the other one is leadership depth, right? Is really understanding like how have we developed leadership at all levels of the organization, and how have we systemized leadership in terms of decision making, in terms of roles and responsibilities, and ideally that we have some kind of leadership plan, right? Like we're evolving leadership as we go, and we're not stuck on one person or people at certain levels running the show all the time, and we haven't really developed any future leaders. A lot of times what I see is you've got a founder CEO in place, and they just keep cycling through their leadership team because 3, 4, 5 years the leader's like, well, I want to do something else. There's nowhere to go except another company, and now you're losing all this talent to other companies. So either you have to grow, right? Like you have to create opportunities inside the business by expanding the business, or you have to have some kind of planning around, okay, like there's some kind of handover or some kind of evolution of leadership in the company. Not easy to do, but if you can do it well, it creates a very valuable situation for a potential buyer.
Yeah, we talked a little bit about value throughout the whole show, and it's probably worth
Yeah.
underscoring what's the big theme with that. And I think theme number one is that if you have a business that can thrive without you as the owner, it'll be a more valuable business. Theme two is, look, we gotta understand where the risk pockets are in the business
Yeah.
and be able to address them proactively. Because if you wait till a buyer comes knocking on your door, well, they're going to be pointing out all the flaws, and then that
Yeah.
equals a discount, right? And what we're after is a premium price, not a discounted price.
Mhm.
Have you seen that in scenarios in your world where
Yeah.
the client is surprised at when the buyers give their offers that the purchase price is so much lower than they would have expected? And what do you think some of the root issues around that?
Well, so I think there's two cases. One is the initial LOI where the number's just not what the buyer was expecting. The other one is during the LOI and during due diligence, they start chipping away at it, and and then the buyers or sellers are like, why is this number that I was actually pretty happy with in the beginning all of a sudden no longer there because what they're finding. So, I mean, in terms of my kind of philosophy in this is, the market sets the ranges, right? The market's going to set, well, this kind of company, this kind of business model, this kind of size, and this kind of region, is trading at 6 to 9 times EBITDA, right? Like you've got some kind of range of things. We can't really control what that range is, right? That's set by the competitive market. It's set by access to capital. It's other investment options that these investors have. What we can do is decide where we fall in that range. So I can't necessarily tell you, we can't really move the range necessarily, but whether we fall in the bottom third, middle third, or top third of that range, we can do. And we can do that by looking at some of the fundamentals of what buyers are looking for in terms of plotting people on that range, right? Like where should you sit on that range based on the nature of the company? And that will adjust somewhat based on the nature of the deal, right? A financial deal is going to look, a little different than a strategic deal. Financial deals are primarily going to look at, well, if I invest cash and capital into the company and we scale it, do they have the ability to get the returns and a time frame, and can I flip it in 3 to 5 years, 3 to 7 years, depending on the fund? The financial buyer is going to be looking at certain levels, and we can do certain things to make it appealing or at least not detracting from a financial. Strategic buyer may look at it differently, right? They may be looking at underlying assets and capabilities, and they may not be as worried about things like client concentration because they're not really thinking about this going to market. They're thinking about leveraging the underlying capabilities or your region you're in or the current customer base you have or the customer base they have and how they're going to leverage it. So depending on sort of those paths, the levers become a little different. But the goal in all of this is figure out what the levers are, and then how do we push and pull those levers so we can get to the top end of that market. Now, I don't know if the top end is going to be 9 times or 12 times or 18 times, but I can do things to move you along that curve.
We have covered a lot of ground. There's a lot that you've shared, which is amazing insights from your experience and your client's experience. Bruce, if you were going to summarize and say 3 things that you want our listeners to take away from this conversation today to build value in their business, make it more scalable, valuable, transferable, what are those things?
Yeah. Well, so the first thing I would say is, exit planning is good business, not just about exits, right? So doing exit planning is going to help your business today. So that's number 1. 2, I talk about the keep sell posture, right? Like I want to be in a situation where I'm ready to sell this business tomorrow, or I could keep it for another 10 years, right? Being okay with that optionality is really important from a negotiation point of view in terms of making sure that you're not just taking the first deal and that you've given yourself, a real choice. And the last one is that idea of have a plan. Like the more you have a plan for what you're going to do after that you're excited and passionate and interested in, it's going to make that whole process easier. It's going to remove a lot of drama. It's going to help you make decisions easier around this. So I'd say if you can do those three things, you're ahead of 95% of the population of business owners out there.
I love that. Totally agree. Totally agree with everything you just said. I've asked you a lot of questions about business. I want to ask you a fun question. So what do you do for fun? What might be something I would be surprised to learn about you?
Well, one of the things I'm known for is these crazy outdoor adventures. So I grew up in Minnesota, and I was always a big fan of the outdoors and camping and hiking and things like that. And the last, say, 10 years, really kind of after I exited, I got really involved in kind of outdoor climbing and trekking and stuff. So I've done a couple of really fun, unique trips. I spent about 3 weeks in the Himalayas climbing. Some of that, we didn't do Everest, but there's a peak just next to Everest. We spent about 3 weeks climbing. So I've got lots of stories of harrowing situations of being on sides of mountains and stuff. Just I love the challenge, and I love the adventure. So
I like that a lot. Yeah, there's a lot of parallels with your role as a company, building a company, helping others build and scale, right? Being with them on their journey. Appreciate that. Look, this has been amazing. I appreciate your time. If people want to get in touch with you, what's a good way for them to find you?
Yeah. So Bruce@Eckfeldt.com is email. Eckfeldt.com is URL for website. And then I'm pretty big on LinkedIn. I've got a pretty good presence there. So just, I think it's in/Beckfeldt. But if you search for Bruce Eckfeldt on LinkedIn, you'll find me.
They will find you, and we will have those links in the show notes. Bruce, thanks so much for being on Succession Stories with me today.
Thank you, Laurie. I appreciate it. It's been an absolute pleasure.
Oh, thank you so much. And if today's conversation for our listeners sparked ideas, how to build, scale, and eventually exit, prepare your business for its next chapter, share this episode far and wide with a fellow founder or leadership team member who needs to hear it. And if you haven't already, be sure to follow the show so you don't miss future conversations with experts like Bruce and founders who are navigating growth, exit, and legacy in real time. Your business is one of your most valuable assets. Build it intentionally. Until next time, I'm Laurie Barkman, the Business Transition Sherpa, and we'll see you next time. Thanks for joining us on Succession Stories. Before we wrap, is your business truly ready, and are you? If you're not sure, that's exactly why I created the Succession Readiness Assessment based on the BUILT method. In just a few minutes, you'll get a clear snapshot of where you stand and what might be holding you back. You'll find the link to the assessment in the show notes, btsherpa.com/succession.